Okay, so that's a 326 crore number on the profit line. That's slightly shy of our estimates. I've got the advertising revenue number. So domestic advertising revenue growth is 22% for the quarter gone by, 22.3%. That's what they've done in terms of the domestic advertising growth. The subscription revenue, domestic subscription revenue is up by about 12%, which is in line with estimates. So that seems to be bang in step. The EBITDA margin at 31.9% should also go down well, because that seems to be slightly ahead of our poll. We were looking at about 31.5%. So on the margin front, this seems to be okay. Domestic subscriptions seem to be okay at 12.3%. And the advertising growth has come in at 22.3%. That also seems to be slightly on the higher end of the expectations. We have Sonal joining in with the details. Sonal, these are the initial numbers that I can bounce off you. How do they look?
Well, in terms of ad revenue, it has come in at 23 point, I'm sorry if you can just...
The ad revenue is 22.3%, the domestic advertising revenue.
So 22.3% is good. We were expecting an ad revenue growth of around 19 to 20%. So 22.3% goes well. In terms of subscription revenue growth, that has come in at around 12.3%. Yeah. That also is better than what the street was expecting. In terms of EBITDA number, that is bang in line what our poll was suggesting. Our poll threw up a number of 561 crores. It has come in at around 564 crore odd. Margins is where it's a positive surprise yet again. We were working with a number of 31.5%. That has come in at 31.9%. Then that on year basis throws up an expansion of around 390 basis points, and this particular margin, if I will look at it, it is highest in last 5 quarters, no, not actually, last 3-4 quarters. So but that number looks really good. I will actually have to go through the...
let me ask you this, Sonal. The advertising revenue, the domestic number for advertising revenue looks very good at 22.3%. The overall advertising revenue is around 11.5%. So I just want to understand, for comparison's sake, the overall advertising revenue, I think that's the headline number we should look at. Right. The overall, that's 18.5%. So that's at the lower end of the estimate band.
Exactly. But still, it should not be really bad, right? 18.5% is on the lower band, and it's bang in line with what we were working with. So it should go well with the street. Doesn't look bad at all. But margin is somewhere I think the street should like that particular number. Operational costs on a YY basis have gone up, and that is the content cost that we were talking about, because they had come up with a new app that is called Zee5, and we also have Karan Taurani, the VP Research at Daulat Capital, who is joining us now on the phone lines. Karan, your first reaction on the results? The ad revenue growth is at around 18.9%. We were working with ad revenue growth of around 19 to 20%. Is it good, inline, bad? What were your expectations?
So our expectation on the ad revenue was about 17%. So it's a tad above, our estimate. And on the subscription revenue front, it's slightly lower than our expectation. We expected about 14% growth on the subscription revenue part. It's come at about 12%. I think the overall key takeaway here would be the margin front. The margin has been much better than our expectation, despite the content cost and despite the investment in the digital platform. But clearly the valuations, are expensive even currently, and the stock has basically, underperformed versus Nifty in the last 3 months. And in absolute returns, I think it's given a negative return of close to 15-20%. So, we do expect some kind of positive uptick in the near term in the stock.
So what is your rating on the stock, and what is your EPS estimate as of now?
So basically, if you see, we have a reduced rating on the stock. And in terms of our EPS estimate for FY19, we are placed at about 15 odd rupees. I mean, we had a reduced rating when the stock price was 600 plus, and based on current valuations, I think we'll probably look to upgrade the stock at about accumulated rating. We currently have a target price of 580 rupees on the stock. We don't expect any major change on the revenue front, but there might be a minor upgrade on the EBITDA margin front, and that could have a positive impact on our earnings.
Okay, I'm just going to read out some commentary on the subscription revenue, which is a bit of a concern for Karan, as he mentioned. He said that the Zee is saying that the revenue number is up, of course, 12.5%. As per the TRAI notification of the 3rd of July, new tariff order will come into effect in 180 days. We've already started discussions with our distribution partners for a seamless transition. That's what they're talking about. The medium-term outlook for domestic subscription growth remains unchanged. So in their statement, they're saying that because of this TRAI order, they're not looking at any immediate changes in their subscription guidance. However, Karan, I want to take up the question on content cost. How much are you penciling in? Because I guess going forward, that's going to be the critical concern with respect to this margin band. This 31.9%, for how long do you think can Zee sustain this?
I think if you exclude the sports business for Zee, Zee could have operated an EBITDA margin of close to about 34%. Given the current investments in the ZEE5 digital platform, given the investment in the increased programming hours, the sustainable margin for the management is about 30% plus. And that's the guidance, which they've actually maintained. But the problem here is, there is a lot of competition coming from the internet and the VOD space. So you have Netflix, Amazon, a lot of these guys investing big amount of money on the digital platform. On the other hand, there is Hotstar as well, which is providing cricket-based content and getting a lot of viewership on their digital platform. So ZEE5 something is very new as of now. They've not been able to get that good amount of viewership as Hotstar has already done. So I think they have to really invest a lot in the digital platform, and that will really, have a huge negative impact on the margin in the near term, actually.
I'll just give some more numbers to this, Sonal, as well. Since we're discussing digital is going to be basically the money guzzler for now. So programming cost is up about 14%, largely across the entire network. And then the advertising, publicity on other expenses are also up 21.2%. And a large part of this advertising and publicity, I'm guessing, is going into a lot of marketing the digital content that they're producing.
That's correct. We see ads, right? ZEE5 ads are there all over the place. So that, I think, is one of the reasons why these costs have shot up. Karan, one more question for you. So international subscription revenue has declined by around 6.5%. We know there has been a demand problem in some of the countries. Do you think this underperformance will continue? Because we were working with an international subscription decline of around 2 to 3%. It's higher than that. What do you make of this number?
So, international subscription revenue has been declining in the recent past in the 3-4 quarters, and management, has indicated a more flattish growth over there. I think the underperformance there, will continue because internationally also the subscription, the viewership is moving towards the digital platform in a faster way than that of India. So, I don't see such huge growth prospect for the international subscription revenue in the near term as well.